Investing is not just for experts. It's for everyone, whether you have $100 or $100,000. In today's video, we will talk about 9 of the most common beginner mistakes that can cost you serious money, as well as some tips that I would give my younger self if I were to start all over again. Let's dive in. The first mistake is waiting too long to start or not even investing at all. I have friends and coworkers talk to me for hours about how excited they are on different investments, but never follow through with the next steps. According to this survey, more than half of Americans still aren't investing because they don't understand it. For some people, they're waiting to start when they make more money. For others, it's the fear of taking losses. But no matter what the reason is, you actually lose money by not investing, because the cash you keep in the bank loses its purchasing power due to inflation. I'm sure everyone watching this video is feeling the pinch of inflation right now. If we take a look at a dollar's worth, in 1933, you can buy 10 bottles of beer with just $1. In 1971, $1 will get you 17 oranges. Now, in 2024, I struggle to find anything to buy for $1 in the store. And that is inflation in action. This is why investing is so important in keeping up with inflation. Also, if you are waiting until you have more money to invest, it adds more risk to your investment because it shortens your time horizon. You miss out on the time needed for the compound interest to work. This graph from the Federal Reserve Bank of St. Louis shows how someone investing $5,000 a year, starting at age 25, for 10 years continuously, then stop investing, would have more money at age 65 than someone investing the same amount starting 10 years later at the age of 35 for 30 years in a row. The sooner you start, the more time you allow your money to go to work for you and earn interest on the interest itself. So get started right away, even if you can only put away a small amount. The next beginner mistake is choosing the wrong type of account to invest your money. This can be the biggest expense of your life, especially if you're not picking an account that can help minimize your taxes. There are 4 types of investment accounts you can choose from: a work-sponsored retirement account, an IRA, a Roth IRA, and a regular taxable brokerage account. Taxes can take a huge bite out of your investment, and that is why picking the right type of account matters a lot. If your employer matches contribution on the 401k, definitely contribute enough to get the maximum matched amount, because who doesn't like free money? Roth IRA is another great option as a tax-advantaged account. On a regular investment account, you need to pay taxes on dividends and capital gain. But with a Roth IRA account, all the profits are tax-free when you withdraw at the age of 59 and a half. Roth IRA is a great vehicle to help you retire as a tax-free millionaire. Check out my videos here to learn more about Roth IRA and the different tax-advantaged retirement accounts that are available to you as a beginner. The next beginner mistake is following the crowd and putting too much faith on hot stock picks from people on YouTube, social media, TV, or even friends. Anyone can recommend a stock, but you don't really know their track record. Some people may only show their wins and hide their losses. And oftentimes, people only hear about an investment after it has already performed well. The hot stock may have already doubled or tripled. And unfortunately, by the time you hear about it, the stock may have reached its peak and it's usually too late to invest. You also run into the danger of people promoting their own stock positions. They may try to mislead others by hyping up stocks they already own to inflate the price, so they can then profit by selling their shares at the inflated price. We don't have to look very far to see this in the meme stock mania in 2021. The price of these stocks went sky high to the moon as a result of the hype on social media, and not necessarily the company's performance. Then these stocks become overvalued and their price drastically plummeted, leaving many holding the bag. You're better off investing in index funds as a beginner. That way, your investment is diversified and you can't avoid putting too many eggs in one basket, which is the next common mistake number 4. It's no surprise that it can be very risky to go all in on 1 or 2 stocks. If the company goes belly up, there goes your entire portfolio. But even if you have 20 different stocks, but 10 of them in the financial sector and 10 in the energy sector, a sudden drop in price of gas or oil could drastically affect half of your portfolio. So try to spread your investments across different companies and sectors. You can also diversify by blending different types of investments like stocks, bonds, or cash. One easy way to go about this is through ETF or mutual funds. Just make sure you pay attention to the hidden cost and fees, which brings us to the common mistake number 5, paying too much in commission. Investment expenses in the forms of commission, expense ratio, and management fees can greatly reduce your net return on investment over time. For example, if you have a 10% return on investment in a fund with a 1% expense ratio, your actual return on investment is reduced to 9%. This little difference might not make much of a difference in a single year, but when multiplied over 10, 20, or even 30 years, the difference can be huge. Let's look at a $10,000 investment with a 10% annual return. If you invested this $10,000 in a fund with a 2.5% expense ratio, the value of your fund after 20 years would be $51,524. But if you invested the same $10,000 in a fund with a lower expense ratio of 0.5%, your investment would be worth $64,122 after 20 years. That's 24% more money in your pocket. Some personal financial advisors can charge a lot of money to manage your portfolios, when honestly, you can do a lot of the same things on your own. Many active mutual funds also have high expense ratio because they require more hands-on management. The average expense ratio for an actively managed mutual fund is between 0.5% to 1.5%. For passively managed index fund, the typical ratio is between 0.2% to 0.4%. For funds that own similar investments, make sure that you compare fees and pick the ones that charge low fees. Next up, common mistake number 6, timing the market. Buy low, sell high is commonly tossed around as a stock trading strategy, but it's much easier said than done. The truth is, no one really knows where the market is going. Even professionals struggle to predict market's tops and bottoms. Here's a fascinating study. In 2023, Charles Schwab compared the performance of 5 hypothetical long-term investors with different strategies. Assuming each person received $2,000 at the beginning of each year for 20 years, starting at the year 2003. First hypothetical investor is Peter Perfect, who had the crystal ball and always timed the market perfectly. He would invest the $2,000 at the lowest point each year. Then there's Ashley Action. She took the simple approach of investing the lump sum of $2,000 on the very first trading day every year. The third investor is Matthew Monthly. He used the dollar cost average approach, divided up the annual allowance of $2,000 into 12 equal portions, and invested at the beginning of each month. The fourth investor is Rosie Rotten, who had the worst timing. She always invested the $2,000 at the very peak of the market every year. Lastly, there's Larry Linger. He left his money in cash and never got around to invest. Who do you think had the best result? Naturally, Peter Perfect, with the help of his magic crystal ball, had the most return. But it's surprising to see that there's only a small difference between Peter, who timed the market perfectly, and Ashley, who simply invested the very first trading day of each year. This goes to show that you don't need to try and time the market. You can achieve great return simply by being consistent with your contribution, regardless of the market condition. It's also encouraging to see that even Rosie Rotten, who always bought at the worst time at the peak of the market, still earned about 3 times more than leaving money in cash like Larry did. It's simply impossible to consistently time the market year after year. The most realistic strategy is to invest consistently, either with a lump sum or dollar cost average into the investment. If you're finding value in this video, give it a thumbs up. It really makes a huge difference. All right, next up, common mistake number 7, trading based on emotions. There's the thrill when you watch your stocks go up in value and the panic when they plunge. But if you allow these emotions to guide your investing decisions, this can lead to buying high because you don't want to miss out, and selling low in a panic, fearful of the loss. This is the exact opposite of what you want to do. Of course, if an investment is not working out and the company is going horribly wrong, you will need to cut your losses. One way to work around emotional investing is to have a long-term investment plan. If you have a longer time horizon, like 10 to 20 years, then it's easier to tune out the noise of short-term volatility. For example, let's say if you bought Google at the peak in 2020 for $75, then panicked and sold it after watching the stock nosedived to $53 because of the pandemic shutdown. You would have lost money. But if you stayed the course and kept the stock in the account, you would have broken even a few months later in July and more than doubled your investment by now in 2024. So make sure that you're investing the money you don't need in the short term. That way, you can ride through the market's ups and downs and avoid making impulsive decisions to sell at a loss because you need the money to pay rent. The next common mistake is trading too frequently. When you're starting out, investing can feel very exciting, and it's very easy to find yourself trading too much. Trading in and out of the position is a return killer. Not only can you lose money in the bid-ask spread, you also pay more in taxes if you sell your position within a year of buying them. Any profit from a trade that is held less than a year is considered a short-term capital gain, which is taxed at a much higher rate than a long-term capital gain. Also, trading frequently does not actually provide better return. This research, published by UC Berkeley and UC Davis, shows active traders underperform the market by 6.5% per year. If you're new to the market, I would recommend just buy and hold for the long run until you gain more experience and understanding of how the stock market works. Okay, last but not least, common mistake number 9, investing before you're ready, both mentally and financially. Before you start on any investment, make sure you have set aside at least 3 months of emergency fund. This will give you the confidence that you can protect yourself from life's unexpected events, so you're able to recover quicker and get back on your feet. And if you have high interest rate consumer debts like credit card debt or personal loan, pay those off first before you start investing. Personally, I consider high interest debt as anything above 10% interest. And in today's high interest environment, credit card debts can have as high as 24% interest rate. It's nearly impossible to find investments that will give you the return to match a 10 to 24% interest on your debt. So by paying that off first, you could save hundreds or even thousands of dollars in interest. That's it for the 9 common beginner mistakes when it comes to investing. I have made many of these mistakes myself, and I'm sharing these with you so you can start your investment journey with open eyes. I hope this video has inspired you to take action and avoid some pitfalls. Thank you for watching, and I will see you in the next one.